let's start first of all by discussing why. Why is it that, relative to other emerging markets where those currencies are strengthening against the naira, in case of Nigeria, it's weakening?
Well, I think the naira has a peculiar case in the sense that the Nigerian revenue profile is all dollar-based. We export mainly oil and gas, and everything is priced in dollars. Our reserves are in dollars. So maintaining a kind of parity with the dollar is not unusual. Now, secondly, our reserves have come under pressure lately. We've come down all the way from $58 billion to $34 billion. It's time to start protecting the dollar by actually depreciating the dollar and adjusting it so that at least imports become slightly more expensive and begin to send a signal that the central bank will have to do less of intervention and more of pricing adjustment.
I think another factor obviously would be the structure of the foreign exchange market here, where it's really only the central bank and the oil companies that are providing the supply.
Yes, the structure is that of a price discriminating monopoly, oligopoly actually. You have the central bank providing about 85% of the supply, and the balance of 15% is provided by the oil companies. Now, the price differential between the two markets is actually something like 1.5% to 2%. So effectively, you find that the dollar is trading in the interbank market at about 153, or 152 to 153, and in the parallel market about 154 to 155.
But there's still the concept of weaker dollar globally. So
yeah.
Are we saying that is not having any impact on Nigeria at all, or where is the impact?
It does have an impact. Nigeria's import from the European Union is about 31% of its total imports. And the bulk of the balance of its imports comes from the Asian countries and some of African countries. Nigeria maintains a trade surplus with the United States, exports 48% of its exports to the United States, and imports only wheat and a few things from the US. So in reality, the terms of trade have actually moved against Nigeria. Effectively, against all other currencies, we've gone down about 14%, because the dollar has lost about 11% against the other currencies, plus the 2% of dollar. Then you have that. Against the pound, it's the 253 or so. Earlier in the year, it was about 218. So that's been a substantial depreciation.
What about our reserves? Because obviously, if we are holding dollar-denominated assets, a weaker dollar is bad for us. But of course, if we're into, say, European assets, that it would be a positive, obviously.
Yeah, but in any case, you would have earned the dollars, and you would have converted dollars into euro or pounds or Japanese yen. And when you want to come back to make payments even to the US, you have to come back in the dollars. I don't think the denomination of your reserves is a hedge against devaluation of market exchange rate volatility. The whole idea is that your exports, the volume of your exports, all you need to do is to export some more. But the adjustment of a currency improves or makes your exports more competitive. But since your exports are priced in dollars, no matter how much you depreciate in naira, it's not going to affect the price of oil. It's only going to affect the price of non-oil exports, which comes to about 2 or 3% of our total exports. So it's insignificant in terms of materiality.
Let's talk about foreign portfolio investments coming into Nigeria. We know that right now the stock exchange is perhaps dominated by foreign investors. But has there been an increase, net, so to speak, over the last, say, 1 or 2 years?
No, we've seen some kind of plateauing off. We saw an increase and we saw a drop. And that drop was because of the global crisis. However, what one wants to find out is that if because of the depreciation of the naira and cheap equities, portfolio investors are now finding naira assets attractive. I think it's too early to say that, but we suspect that that's going to happen, especially after the closure of the rescued banks. You are going to see portfolio investors coming in, want to buy cheap assets, to take advantage of the depreciating naira. I think that will help. But coming back to the structure of the market, we hear and we understand that it's been muted, that there's going to be, right now it's all a spot market, and there are no forward markets, forward positions in the Nigerian market. We understand the central bank is willing or considering becoming a counterparty for forward transactions. Our view, or some of the analysts' view, is that the central bank will be best served by being a guarantor of forward transactions rather than being a primary obligor of forward transactions. In other words, if people who qualify as participants in the spot and forward market, if there's a default in any of those transactions or somebody walks away from a forward transaction, central bank can compel that party to come forward, or if failing which, that bank's account is debited and is compelled to actually come up, so that you instill discipline in the forward market. However, when you now have a spot and forward market, you actually reduce the amount of volatility in the spot market, which is one of the features of the current situation.
Well, I imagine that the central bank will be looking for new ways to at least stem the volatility which we've seen in the Naira. But on a final note, let me take you to the outlook for the Naira, because I think you are one of those that have mentioned that you anticipate further depreciation going forward, even though some traders that I've spoken with are somewhat more conservative, and they think that we'll probably see the central bank coming to the table, and of course with the oil companies also coming in, we should have a fairly stable Naira going forward. But why are you so, should I say, bearish about the Naira?
No, okay, I can understand. Traders are tactical and are technical. Analysts are fundamental. When I look at the fundamentals, three things come to mind. One, the price of oil, which is stable. Two, the differential between the inflation rates. The inflation rate in the US is less than 2%. Our inflation rate is 13.6%. I cannot see any justification for appreciating a currency in a high inflation country against a currency in a low inflation country. It doesn't happen. And if you're trying to force it, you are creating an artificial situation. Thirdly, you only intervene. The frequency and volume of intervention determines the outcome. The reserves are down. So supposing the reserves go all the way down to, hypothetically, to a figure which is not sustainable, you have to adjust. And the adjustment have two components. One, the exchange rate adjustment. Right. The other one, the interest rate adjustment.